Hello everyone, and welcome back to our 10-minute Financial Essentials series. Today we're tackling one of the most critical and often misunderstood aspects of our sector, charity fund accounting. If you come from a commercial background, this is usually the biggest hurdle to clear. In a normal business, a pound is a pound. It goes into one big pot called the profit and loss. If you have money in the bank, you can spend it on anything. In a charity, this is not true. We don't just track what we have spent money on, like salaries or rent. We have to track where the money came from and what restrictions are attached to it. That is the fundamental difference between charity accounting and normal business accounting. We aren't just measuring profit, we're proving stewardship. We need to be able to explain to our donors how their money is used, and for this, we use funds. So let's define the buckets or funds that hold our money. Generally, we look at three main types. There are unrestricted funds. This is money the charity can spend on any of its charitable objectives. This is your general operating money. Secondly, there are restricted funds. This is money that must be used for a specific purpose that was defined by the donor. Endowment funds are capital that usually must be held permanently, but we may be able to spend the income. A restriction is not just a preference. It is a legal constraint imposed by the donor or the terms of the grant. If a donor gives you £10,000 specifically for youth housing, you cannot legally spend that on senior care or general marketing. That money sits in a restricted fund. Now, if we, the management, decide to set money aside, say for a matched funding project, that is not restricted, that is designated, and we can change our minds later. Restrictions come from the outside, donations come from the inside. All of this feeds into the statement of financial activities, affectionately known as the SOFA. Unlike a commercial profit and loss account, the SOFA is split into columns representing these funds. Unlike a commercial profit and loss, the SOFA is split into columns representing these funds. All charities with income greater than £250,000 or euros must comply with the SORP, and producing the SOFA is the element that many newcomers to charities find the most challenging. The income and expenditure must be grouped very carefully according to the designations in the SORP, as well as being divided by the fund type. Inexplicably, to me at least, the SORP balance sheet is not required to be presented by fund type, although in practice it has to be. All assets and liabilities, accruals and prepayments, even manual journals, must be allocated to a fund. Fund accounting does not just apply to income and expenditure, as the SORP seems to infer. In Eden Dot Charities, we remedy this by offering you not only a balance sheet organised by fund, but the trial balance also. There is a further wrinkle, which is driven out of a very practical need. How does the charity pay for its support and governance costs? Initially, all expenditure must be grouped into one of three project buckets: the charitable activities, what the charity was set up to do, the fundraising costs, and support and governance costs. Support and governance costs are then allocated across the charitable activity and fundraising cost buckets according to any method that the charity sees fit. The big advantage of this allocation is that it then allows reserved funds to pay for a reasonable proportion of the central overheads, which would otherwise all have to come out of the unrestricted funds. Now, the method of allocation varies according to the nature of the charity. It can be based on simple expenditure, headcount, time, floor space, or anything else which is sensible for your charity. To manage all this complexity without losing your mind, in Eden Charities, we use a three-dimensional coding structure for every single financial transaction. The nominal code is the what. What is the nature of the transaction? Is it rent, salary, or travel? The fund is the who. Who is paying for it? E.g. the general fund, or one of the restricted funds, a youth grant, building fund itself. The project code is the why. Why are we doing it? Is it for the summer camp, annual conference, or for governance costs? By tagging every invoice or receipt with these three codes, nominal code, fund, and project, Eden automates a separation. You don't need manual spreadsheets to figure out how much is left in the youth fund grant. The system tells you instantly because the fund code was applied at source. Similarly, your project manager knows exactly how much they have to spend, and you can monitor them against their budgets. If you follow this rule, you will find the allocation of costs and therefore the compliance with the SORP is much easier. It also helps with your partial VAT returns if that applies to you, because each project can be identified as taxable, exempt, or residual. Occasionally, you may need to move money between funds. This is called a transfer. For example, you might need to transfer unrestricted funds to cover a deficit on a restricted project, or move money into a designated fund for a future building. However, you generally cannot transfer out of a restricted fund into the unrestricted reserves unless the donor lifts their restriction. In order to record the transfer, you cannot simply debit one fund and credit another. You must transfer an asset as well. The easiest asset to transfer is cash. So you may just allocate a portion of the bank account from one fund to the other. Now, there's a further critical distinction that often trips up trustees and finance officers. Your unrestricted funds figure is not the same as your free reserves. If you look at your balance sheet, you might see, say, £100,000 in total unrestricted funds and think, great, I have £100,000 in reserve to spend. This is quite often wrong. To get to your true reserves figure, you must take the total unrestricted figure and deduct two things. Firstly, fixed assets. If £40,000 of that money is tied up in your building, your van, or your laptops, you cannot use it to pay next month's salaries. Or you may have designated funds. You may have ring-fenced, say, £25,000 for future projects. So while your unrestricted funds might sit at £100,000, your available free reserves might only be £35,000. It is vital to report this free reserves figure to the board so they don't make decisions based on cash that is actually tied up in bricks and mortar. Everything we've discussed today is anchored in the 2026 SORP, Statement of Recommended Practice. The 2026 SORP introduces several important new changes: tiering, volunteer and ESG reporting, plus the new FRS requirements for leases and revenue contracts. We have other 10-minute essentials which cover these topics. But at its heart, the SORP continues to emphasize transparency. It requires us to clearly distinguish between what we can spend, unrestricted, and what is tied up, restricted, ensuring that donors can see exactly how their contributions are being used. To summarize, fund accounting is a legal, not just technical requirement. It separates money based on donor intent. Allocate your support costs. Use restricted funds to pay for their fair share of governance and support to protect your unrestricted reserves. Code comprehensively. Always use the nominal code plus fund plus project to keep your reporting automated and SORP compliant. Thank you for joining this week's 10-Minute Financial Essentials. I'll see you on the next one. Goodbye for now.